Warren Buffett is one of the most successful investors of all time, known for his expertise in the stock market and his ability to make sound investment decisions. In this video, we'll be discussing his warning about a potential market crash that he believes could be worse than the crash in 1929. This warning has caught the attention of many investors, and it's important to understand the reasons behind it and what it means for the future of the economy. We'll be examining the current state of the economy, including the stock market, to see if there are any signs that support Buffett's prediction. Additionally, we'll be discussing why his warning is significant in today's economic climate and what steps investors can take to protect their assets in the event of a market downturn. Understanding the potential risks associated with market crashes is essential for investors who want to prepare for the future and make informed decisions about their investments. Warren Buffett's warnings about a potential market crash has garnered significant attention in the investment world. He first made this statement in 2018 during an interview with CNBC. In the interview, he expressed concern about the high levels of debt and inflated stock prices, which he believes could lead to an economic crisis. Buffett's warning is significant because of his reputation as a successful investor and his ability to predict market trends. He stated, "We have, I don't know, 6, 7, 8 times as many people trading stocks as we had back in 1950, and most of those people are just buying and selling them, so they are not contributing anything to any company. So, you have this tension between the people who are trying to make money in stocks and the companies they are trading." Buffett believes these factors could combine to create a market crash that could be worse than the crash in 1929. This warning should be taken seriously by investors, as Buffett has a history of making accurate predictions about market trends. Understanding the implications of his warning is crucial for investors who want to prepare for the future and protect their assets. The crash of 1929 is one of the most significant events in U.S. economic history, and it's important to understand its impact to contextualize Warren Buffett's warning. The crash was caused by a combination of factors, including a stock market bubble, high levels of debt, and a failure of several large banks. The crash had a devastating effect on the economy, leading to widespread unemployment, a sharp decline in GDP, and the Great Depression. Comparing the 1929 crash to other market crashes in history, such as the dot-com bubble of 2000 or the financial crisis of 2008, highlights the similarities and differences between these events. While the causes and outcomes of these crashes vary, they all share the common thread of being sparked by unsustainable market conditions. The lasting effects of the 1929 crash on the economy and society as a whole are still felt today. It led to the creation of the Securities and Exchange Commission, SEC, and other regulator agencies designed to prevent another market crash. Additionally, it changed the way people viewed the stock market and investing, leading to a greater emphasis on long-term investing strategies and risk management. Understanding the impact of the 1929 crash can help investors prepare for potential market downturns and make informed decisions about their investments. Warren Buffett's warnings about a potential market crash is especially significant given his reputation as an expert investor and his successful track record in predicting market trends. Buffett has consistently demonstrated his ability to identify and navigate complex economic conditions, making his warning all the more noteworthy. His concerns about a crash worse than 1929 stem from factors such as high levels of debt and inflated stock prices. As more and more people invest in stocks with the goal of making quick profits, the underlying value of the stocks may be overlooked, leading to a bubble that could eventually burst. This could result in significant economic consequences, including widespread job loss, declining GDP, and social unrest. Understanding the potential consequences of a market crash is crucial for investors who want to protect their investments and prepare for the future. By heeding Buffett's warning, investors can take steps to mitigate risk and make informed decisions about their investments. Given the potential risks of a market crash, it's important to take steps to protect your assets and prepare for potential economic downturns. One way to do this is by diversifying your investments across different asset classes and avoid excessive debt. By spreading your investments across stocks, bonds, and other assets, you can reduce your exposure to any one particular market. Additionally, maintaining a strong emergency fund can help cushion the impact of any financial shocks. Seeking the advice of financial advisors and investment professionals can also be helpful in navigating economic uncertainty. These impacts can provide guidance on investment strategies and risk management techniques that can help minimize the impact of a market downturn. Ultimately, the most important thing is to take action and prepare for the possibility of a market crash. By staying informed, diversifying your investments, and seeking professional guidance, you can protect your assets and weather the storm if and when it arrives. In summary, Warren Buffett's warning about a potential market crash worse than 1929 should not be taken lightly. The crash of 1929 had a lasting impact on the economy and society as a whole, and a similar event could have devastating consequences today. Buffett's warning is especially significant given his reputation as an expert investor, and his concerns about factors such as high levels of debt and inflated stock prices should be heeded by all investors. By diversifying investments, avoiding excessive debt, seeking professional guidance, and staying informed about economic conditions, investors can take steps to protect their assets and prepare for the possibility of a market downturn. In conclusion, we encourage viewers to take Buffett's warning seriously and to take action to protect their investments and financial future.